Welcome to Iron Financial, the only place to forge a stronger portfolio and cut through market weakness. I'm your lead analyst. Today, we're putting a portfolio titan under the microscope, McDonald's. For decades, this company has been a golden fortress in the global market, a bastion of stability and cash flow. But every fortress, no matter how strong, eventually gets tested. Right now, McDonald's is facing an economic siege. The consumer is under pressure, inflation is biting, and the walls are being watched for the first signs of a crack.
And the moment of truth is today, February 11, 2026. The Q4 2025 earnings report is about to drop, and I'm your market skeptic. Let me be clear. Investors aren't just looking at the top and bottom lines anymore. They're stress testing the entire structure. They're looking for any sign of weakness, any hairline fracture in the armor of this global giant. This isn't just about one quarter. This is about whether the entire narrative of consumer resilience, the story that has propped up this stock for the last 2 years, is hype or if it's real.
And that's really the core question we're going to answer in this explainer today. You know, when we look beneath those golden arches, what are we going to find? Are we going to see a foundation made of solid steel? Something built to withstand any economic storm you can throw at it? Or are we going to find a fragile facade, a hollowed out structure that's just ready to crumble under the immense weight of consumer pressure and this inflation that just won't quit? The answer to that question is going to determine if this is a generational buying opportunity or just a value trap waiting to spring on unsuspecting investors.
All right, let's get to it. Time to forge our position. So here's our roadmap for the analysis. Here's how we're going to break this all down. First, we're going to establish the legend of the Golden Fortress. Then we're going to deconstruct the McDonald's machine. We're going to get right under the hood of the bull case and see what really makes it tick. After that, it's time for the stress test, and that's where the bear case really comes into play. We're going to actively look for the cracks. Then we'll analyze the company's digital reinforcement strategy, preview the critical Q4 earnings that are dropping today, and finally, we'll deliver the official Iron Financial verdict. Let's dive in.
All right, look, before we start trying to poke holes in this thing, you have to respect the history. You got to give credit where it's due. We're talking about a company that started as a single burger stand back in the 1940s and somehow became this global empire. The legend of this fortress? Well, it was built one brick at a time, over generations.
Exactly. And this timeline, it's not just some boring history lesson. This is the actual blueprint for corporate dominance. I mean, look at the strategic evolution here. In the 50s, Ray Kroc, he doesn't just sell hamburgers. He builds a revolutionary franchising system. Then through the 60s, 70s, and 80s, they don't just expand. They literally engineer cultural icons, the Big Mac, McNuggets, the Happy Meal, and they fundamentally changed how we all eat with the drive-thru. In the 90s and 2000s, they weaponize value with the dollar menu and create one of the most successful marketing campaigns in history. And now, today, in the modern era, they're not sitting back. They're accelerating the arches with a full-on press into digital, delivery, and loyalty. This is a company that has proven, decade after decade, that it knows how to adapt and conquer.
So let's put some hard numbers on that dominance. This right here, this is the first pillar of the bull case. Just unparalleled global reach. Over 43,000 restaurants. Just think about that physical footprint for a second. Forget the food. This is a real estate empire that's just masquerading as a fast food chain. No competitor even comes close to this kind of scale. This is the very bedrock of the fortress. Okay, the scale is impressive. I will grant you that. 70 million customers served every single day is a mind-boggling number. It truly is. But a fortress is only as strong as the people inside it, right? The real question today, the one this earnings report is absolutely going to answer, is how loyal are those 70 million people? Are they still showing up when a Big Mac meal now costs $10? Is that a luxury they just can't afford anymore? That 70 million figure, yeah, it looks solid on a slide, but it could be a whole lot more fragile than the bulls want to believe.
And see, that brings me to the next pillar of the fortress, geographic diversification. Operating in over 100 countries, that isn't just a vanity metric, it's a strategic moat. It's a massive defense. When the U.S. consumer gets a little cautious, a little squeezed, strength in Europe or Asia can completely offset that weakness. It's an incredibly resilient structure that insulates the parent company from those regional economic downturns. This isn't just a U.S. story, it's a global one.
Okay, so we've seen the sheer size of the fortress from the outside. Now it's time to look under the hood. Let's really deconstruct the machine itself and look at the steel framework of the business model. This is what truly makes McDonald's a cash flow juggernaut, and it's the absolute core of the bull case. So forget the burgers for a minute. Let's talk about the financial engineering.
It all starts with this one concept: A philosophy that Ray Kroc established decades ago, the three-legged stool. It's simple. It's made up of the franchisees, the suppliers, and the company employees. The entire system is built on this one idea, that for the stool to be stable, all three of those legs have to be strong and balanced. The franchisees, they're the entrepreneurs, the owner-operators on the ground. The suppliers make up this hyper-efficient, integrated global supply chain. And the employees, well, they execute the vision. This symbiotic relationship is the source of its legendary stability.
In this slide, this is how that philosophy translates into a profit machine. It's brilliant. A staggering 95% of McDonald's restaurants worldwide are owned and operated by local franchisees. So for the vast majority of its locations, McDonald's isn't in the low-margin business of selling burgers and fries. No. It's in the high-margin business of collecting rent and royalties. It functions more like a landlord and a brand licensor. This is the key. It creates these incredibly predictable, stable, high-margin revenue streams. Whether a franchisee sells 100 or 110 Big Macs on a Tuesday doesn't dramatically swing the corporate bottom line. That right there, that's the insulation.
Now let's see how this all plays out in the actual numbers. So this is the revenue breakdown for fiscal year 2024. The US market, it's a beast, as you'd expect, bringing in 41% of revenues. Next up, you've got the international operated markets, what they call IOM. Think of these as mature markets like Canada, the UK, and Germany, and they bring in another 49%. The last 10% comes from what they call international developmental licensed or IDL markets. These are your high-growth regions like China and Brazil.
But now, look at this slide. This is the crucial point. This is the absolute core of the financial fortress. This isn't revenue. This is operating profit. Now, the US and IOM are still massive profit centers, of course, but focus on that IDL segment, the high-growth markets. They generated only 10% of the sales, but they delivered 14% of the profits. Let that sink in. This is the financial engine at the heart of the machine. It is a capital-light, royalty-heavy model that is just absurdly efficient and profitable.
And if you drill down into the US, the bedrock market, you see that exact same stability. The percentage of franchise restaurants is incredibly high and has been rock solid for years, taking up to over 95% in 2024. This isn't a company that's just experimenting with its model. No, this is a finely tuned, highly optimized machine. Add to that the fact that over 95% of US locations have a drive-thru, a critical asset for convenience and for volume, and you have a domestic operation that is built like a tank, designed to do one thing: pump out consistent, predictable cash flow year after year after year.
A tank, huh? Built like a tank? You know, every fortress looks impressive in peacetime, but we are not in peacetime. We're in the middle of a consumer recession, whether the government wants to call it that or not. So now it's time for the stress test. It's time to see how this beautiful, efficient structure you're describing actually holds up against the real-world pressures of 2026. This is the bear case. Let's start kicking the tires and looking for some cracks.
And you know what? We don't have to look very far. This isn't my speculation or some bear market rumor. This is a direct quote based on the company's own admissions. They have openly acknowledged that their core, value-seeking customer is pulling back. The lower-income diner, the person who forms the bedrock of that 70 million a day figure, is being squeezed so hard by the price of essentials that they are visiting less often. This is the central threat. This is the first undeniable crack in the fortress wall.
And this brings me right back to your beloved franchise model. You say it insulates the corporation. Fine. But the franchisees are on the front lines. They are the ones dealing with soaring labor costs, with wage inflation, with higher prices for beef and potatoes. They have to pass those costs on. So how much more can they raise the price of a Big Mac before the extra value meal is no longer a value? I mean, what happens to the entire fortress when its very foundation, affordability, starts to crack? What happens when McDonald's is no longer the cheap option?
But management isn't just sitting there watching this happen. They're actively defending their turf by relaunching and heavily marketing these value-oriented offerings. They are reinforcing their value proposition to win back those exact diners. Reinforcing value? Or are they forcing franchisees to sell low-margin items when their own costs for labor and supplies are just skyrocketing? That's not reinforcing. That's creating tension. It puts immense stress on that three-legged stool you were so proud of. I mean, how long can the company squeeze its own owner-operators before one of those legs starts to get a little wobbly?
Because they aren't just playing defense with value meals. That's just a tactical response. The strategic response, the long-term project, is about building entirely new fortifications. McDonald's is leveraging technology to construct a modern moat around the business, one that's designed to make the customer relationship stickier and, frankly, less dependent on price alone. This is how they're future-proofing the fortress.
This right here is the Accelerating the Arches strategy in action, and it's a multi-pronged assault. They're modernizing their marketing, they're doubling down on their core iconic menu items, and then they're attacking with a technological blitzkrieg. They are building out the app and the loyalty program to create a direct-to-consumer channel. They're embracing third-party delivery to meet customers wherever they are, and they're using technology to optimize the drive-thru for speed and efficiency. This is a comprehensive plan to strengthen every single facet of the business.
And here is the proof that it is working. This data point right here is the crux of the entire bull argument for the future. Customers in loyalty cohorts typically visit twice as often as casual buyers. This is the bull's answer to the consumer squeeze. By getting customers into their digital ecosystem, they are fundamentally changing their behavior. They are doubling their visit frequency, and they're building a relationship that isn't just about the dollar menu anymore. It's about loyalty points, personalized offers. This digital moat could end up being even stronger than their physical one.
That's a nice theory. It really is. A very compelling narrative. But narratives don't pay the bills. The debate is interesting, but the moment of truth is now. We need to get back to the immediate catalyst, the Q4 2025 earnings report that is about to drop. The numbers are what matter. The numbers will tell the real story of whether that fortress is holding or if the cracks are starting to spread.
All right, so here's the scoreboard. These are the consensus numbers from Wall Street that McDonald's has to hit today. The market is expecting earnings per share somewhere between $3.04 and $3.05, which would represent a 7 to 8% increase year over year. Revenue is expected to be around $6.8 billion. Let's just be clear about something. For a company of this immense size, in this inflationary environment, that kind of growth would be a testament to its structural strength and its operational excellence. It's not explosive tech growth, but in this market, that's powerful.
Sure, the analyst community is slapping buy ratings on it. Of course they are. Over 71% are bullish. But you have to read the fine print. The overall tone is cautious but constructive. You know what that is? That's Wall Street code for we like it, but we're nervous. Every single bull report acknowledges the same risks we've been talking about: the cautious consumer, wage inflation, margin pressure. They know the headwinds are real. And that means a simple earnings beat tonight is not going to be enough. The real story, the real move in the stock, is going to come from the guidance for 2026. Without a strong outlook, all those bullish price targets are just fantasy.
And that brings us to the end of our analysis. We've examined the fortress, we've deconstructed the machine, and we've stress-tested the foundation. We've weighed the bull case against the bear case. So now, it's time to sift through all the evidence, cut through the noise, and deliver the official iron financial verdict.
So this is really the core conflict, right? On one hand, you have the bull case, the franchise fortress. It's a resilient, high-margin business model with massive global scale and a proven digital growth engine. It is a classic defensive stock that you want to own when the economy starts to slow down. But on the other side, the bear case is just staring you right in the face. The consumer is being squeezed, inflation is absolutely crushing margins, and the entire value proposition that built this empire is now under threat. Those aren't small headwinds. That is a hurricane blowing directly at the gates of the fortress.
So here it is, the iron financial verdict. We see McDonald's as a structurally sound fortress that is facing a temporary but very intense siege. The long-term foundation is solid steel. That business model, the digital strategy, that's not going anywhere. However, the battle at the gates is going to be volatile. For long-term investors, a significant dip on this earnings report should be viewed not as a crack in the foundation, but as a strategic buying opportunity. But for short-term traders, beware. This could absolutely be a value trap. Do not expect a smooth ride.
So that's our analysis. The earnings call is just hours away. And the final question, it isn't for us, it's for you. Look at your own positions. Assess your own risk tolerance. Is your portfolio forged from iron, ready to withstand the coming volatility? Or is it built on a fragile foundation that could crack under the pressure of today's market-moving news? The time to decide is now.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.